What's up, everyone? My name is Ale. Welcome back to my world of stocks, and welcome back to my 3 stocks on sale series, where I look at all the current market volatility. For example, the tech heavy NASDAQ has already crashed by over 30% from its highs, and I try to give you guys 3 new stocks to consider as they fall. And these are stocks that have crashed by huge amounts. They're currently down a lot, but they also have very strong or very interesting businesses that are either already dominating or at least have the potential to dominate their respective markets in the future. And to make things even more fun and interesting, I specifically choose one low risk stock, one medium risk, and one high risk stock to give an even wider variety of risk versus reward. As always, though, I only do this for fun and to give you guys some different ideas of what's out there and available in the market, but you always have to do your own research and make your own decisions. These are stocks that have been crashing, they might continue to fall, and that's just the risk that you take as a long-term investor. And if you're someone who likes to buy stocks as they're going down, there's always the possibility that they may fall even more. But if you're enjoying the series and you like it, then please consider hitting that like button and subscribing. It really helps the channel survive and grow, and it means a lot to me. But with all that said, let's go ahead and jump into this new list of stocks. Okay, so as always, we'll be starting first with our low risk option, a stock that is very likely to perform well over the long term. And this time, I'm going with Facebook and Instagram parent company Meta, ticker symbol FB. And I already know what you guys are thinking. How could I possibly choose this as a low risk option when they're in the middle of restructuring their entire business into the metaverse, which is a venture that is unlikely to bring in any sort of profits for them for many years, at least just when looking at that specific part of their business. And it's also at a time when Facebook itself, the platform, is struggling to grow their user base as they compete with younger generation platforms like TikTok, for example. But I would argue that this is exactly the reason why they do need to transition over to the metaverse, and the sooner that they do it, I think the better off they will be. First of all, the metaverse is only in its infancy right now, but everyone is taking notice of its potential, with many giant companies spending tens, if not hundreds of billions of dollars either directly on it or through proxy. For example, Microsoft is acquiring gaming giant Activision Blizzard for a massive almost $70 billion, to which Microsoft CEO said that it will play a key role in their growth and expansion into the metaverse through the gaming side of things. Not to mention that he also recently talked to investors about e-commerce and business through the metaverse as well. You also have Google, who's been working on their own augmented reality glasses for things like entertainment, shopping, and even business and work. And even more recently, Google CEO told investors that they're considering bringing their own platforms like Maps, Meet, and even YouTube into the metaverse as well. Not to mention that they even invested in another $40 million recently into a private equity fund for working specifically on metaverse projects. There's also Apple, who told investors that it plans to build metaverse applications into their own hardware. There's the chip maker Nvidia, who is building their Omniverse platform that provides metaverse developers with the tools they need for creating virtual worlds. And there are many more, pretty much countless examples of this going on around the world and in many different companies. My point being that the metaverse is likely to have huge future potential for companies that invest early on and that invest heavily in it, while the total market size for it is expected to reach close to $1 trillion over the next decade alone. So is Meta pouring giant amounts of money into a new market that still needs to be proven and thus brings on a lot of risk? Yes, of course it is. But I would argue that with social media market share of well over 80%, with a total user base of over 3.6 billion people, which is close to half of the entire world's population, with huge cash flow generation of almost $60 billion last year alone, which is up by almost $30 billion from just a few years ago, and an absolutely massive balance sheet with more than 3 times the current assets of current liabilities and more than 4 times the total assets of total liabilities, I just think that a lot of the risk is mitigated with a company like Meta that is already in the perfect position to go in much earlier and much heavier than most other companies. And it's something that I feel they really need to do. And considering that the stock has already crashed by well over half of its entire value, leaving it now trading for almost the same price as when the entire market crashed in 2020, and with a dirt cheap valuation of a PEG ratio below 1 and a PE ratio that is around 20% cheaper than the rest of the sector, I think that also brings down the risk a lot more than it otherwise would be. I mean, there's just no way that you can convince me that the world leader in social media and a company that is gigantically more profitable than most other companies out there, that company deserves to be trading cheaper than the sector. If anything, they deserve to be trading for a significant premium. So for Meta to be trading at these lower levels, it doesn't make a whole lot of sense to me, and it's one of the reasons why I'm invested in them myself, but for the long term. Moving on to stock number 2 though, that'll be our medium risk option. And for this one, I usually try to pick a dividend paying stock just because a dividend can help lower the risk a bit even if the stock is crashing. And this time I'm going with the only bank stock that I own myself in JP Morgan Chase, ticker symbol JPM. And the reason why is very simple. Chase is, in my opinion, the safest and most reliable bank stock among the biggest players. Not only do they have the most US market share by deposits, not only do they have the most market share by assets, not only has the stock performed the second best over the past 5 years, only slightly behind Bank of America, but they're also known for being one of the most reliable and stable of the big banks as well. In fact, during the '08 financial crisis, Chase was one of the very few banks that actually helped stabilize the economy by acquiring other banks that were collapsing while also giving out badly needed loans. And even during the 2020 pandemic and lockdowns, Chase stock fell by the lowest amount of the big five. And that was while also passing their own stricter stress test of a huge 35% recession. Now, speaking of a recession, that's where all of the risk really comes into play with this stock, because obviously a company that relies on consumers and businesses spending money, taking out loans, and paying interest will get absolutely crushed during an economic downturn. And of course, we're currently in one right now with the US GDP dropping about 1% last quarter. But I still think that this is something that Chase can handle fairly easily. And even if it drops again this quarter, the GDP, which would technically make it, the technical definition of a recession 2 quarters in a row, I don't necessarily think that it's going to be devastating enough to warrant such a huge crash in the stock, as it has already crashed by well over 30%, leaving it now trading close to a 52-week low and with a trailing PE ratio that is about 10% cheaper than the rest of the sector. Again, that's despite being the market leader with very strong financials, including record-breaking sales and profits last year of over 130 billion and close to 50 billion respectively, and are still expected to grow sales slightly this year at a time when many other banks are actually in decline, and then still do over 7% next year, even with all of the doom and gloom predictions being priced into the market. Their share price is also now lower than most analysts' price targets, including even the lowest bear case scenario targets, which has also left them with perhaps the best reason of all to own JP Morgan stock long term, and that's the dividend. At these levels, the yield has now climbed to almost 3.5%, despite having already some of the best growth metrics that you could ever really ask for in a dividend stock, like for example a super low payout ratio of less than 30%, a high growth rate of 15%, and almost a decade of consecutive growth to go along with it. Plus, when you look at the yield over the past 10 years, you'll see that it rarely ever gets to these levels. It almost never climbs above 3%, and the only time that it was higher than where it is today was back in the 2020 market crash. So if you want to get a higher yield than what you can get right now with it, you're going to have to wait for a crash that reaches those same levels again as it did in 2020. And sure, we might reach those levels again this year. That is definitely possible, but I don't think it's very likely. In 2020, we literally shut down the entire economy. That never really happens. And while I am very pessimistic about the current state of the economy, I don't think I'm that pessimistic to the point where I think we would reach those levels again. Anything can really happen in the short term, and I could lose my head just trying to keep track of everything and trying to predict what happens this year, next year, and anything over the short term, where the market goes. Or I can just buy the stocks that I like long term, and when they crash lower, I can add to those positions and hold on to my investment for the distant future. And I generally just prefer the latter of those options. Anyway, that brings us now to the third and final stock of the day, which is also our high risk option. And for this one, I usually go with speculative stocks that are sometimes even unprofitable, but that do have a lot of long-term future potential. And today, I'm going with a spec stock that I do not own yet myself, but one that has always been very high up on my watch list, and as it continues to crash, it is getting extremely tempting to start dipping my toes in, and that stock is CRISPR Therapeutics, ticker symbol CRSP. Now, this is a biotech that is known for their revolutionary work in gene editing through their CRISPR-Cas9 platform that allows them to treat diseases by modifying or editing the DNA of human beings. This is done by one of three methods, those being to either go in and disrupt the DNA, which causes it to become inactive. They can also go in and delete a fragment or a sequence of the DNA. And lastly, they can also go in and just actually fix or insert their own gene into the sequence. And it's pretty crazy stuff, and the theory is that in the future, many diseases, especially genetic ones, will be able to be treated or even cured using this revolutionary technology that is also much more efficient as well. And even this could be even applied to some of the most complex diseases that we haven't been able to find cures of, like for example, cancer. In fact, one of the things that CRISPR has been working on over the years is the ability to alter T cells in the body so that they attack and destroy cancer specifically. And if all of a sudden your product can start treating and curing these various diseases, well, there's likely a huge amount of profit to be made from that too, and it's also one of the reasons why CRISPR is one of the largest holdings of Cathie Wood, who is famous for investing heavily in disruptive technology. At the moment, CRISPR is the fourth largest holding of her flagship ARK Innovation ETF. Unfortunately, though, this is a company that does not currently have their own commercial product yet, and thus all of their sales have actually been made through collaborative partnerships, which has resulted in their financials being extremely volatile and all over the place, really, depending on what therapies are approved during a given time. One year, you might see no sales at all with huge losses, while the next you might see explosive growth on both the top and bottom line. For example, this year sales are expected to plummet by almost 99%, while next year they're expected to skyrocket by close to 2,000%. And that's in large part because of their partnership with Vertex Pharmaceuticals, who is helping them develop a potential blockbuster treatment called Exa-cel that is currently in late stage trials for treating patients with TDT or severe sickle cell disease. The latter, by the way, is a disease that affects around 300,000 new people every year. So CRISPR's single-dose treatment could be an absolute game changer. They also have a growing pipeline of their own new treatments for the future, and when looking at the overall gene editing market, it's expected to grow to nearly $20 billion by 2030, which is up from around $5 billion last year. To give you some context, CRISPR's enterprise value is only less than $3 billion right now. So because they're the market leader and the closest to market in terms of new products, CRISPR stock might be trading at a discount today when compared to the long-term future potential, especially when you consider that it's already crashed by a whopping over 70% from its highs, where it was once a super high-flying spec stock. As a result, their trailing PE ratio is now only around 16, while their price-to-sales ratio is only around 5. Compare that to a year ago when their enterprise value was more than $10 billion and their PS ratio was over 10,000. I'm not saying that it automatically makes a stock a buy. It's definitely a huge risk because they're still not commercialized in any really meaningful way, and if regulators stop some of their products or if more competition emerges, then yeah, the stock is going to crash by even more. But at today's levels, I gotta admit that it's getting more and more attractive the more that it falls, and Cathie Wood seems to think the same thing here, as she's been buying tens of thousands of shares in recent months, even as early as here in June. I'm personally still on the sidelines with this one because I already just own way too many spec stocks, as I've mentioned in a lot of recent videos, but it's getting to the point where CRISPR is getting too attractive to ignore the more that it falls and crashes. And at some point soon, I might want to just start dipping my toes in this one because I do think that they have a lot of future potential if they become successful, and that could set it up for some nice gains even with just a very small position. But anyway, that's how I feel about these stocks. Today's list of new stocks that I feel are on sale. Let me know if you agree with the list. Do you have any stocks that you think are on sale that should make the list? Let me know down below. I may include them in the future episode. And let me know what you're invested in. Are you invested in any of these? What are your thoughts on these stocks? I'd love to hear your thoughts down below. I'll try to respond to as many comments as I can. Thank you so much for watching. Thank you for all the support. It means a lot to me. And I will catch you in the next video. Hope you're all doing well. Take care. Bye-bye.